I'm sure you're all excited. Welcome back to part 3 of 6 for the 6-figure portfolio. Okay, how to build it. So, in part 3, I'm going to go into starting your investment. So, you've sorted your investment pot, and number 2, you found your broker online that you prefer, that you followed my conditions, and now you're starting investment. So you've deposited your money that you think you can start off with. What do you do next? Of course, you're gonna ask, who do you buy? Where am I gonna buy? Apple, Microsoft, or maybe that Bank of China? Hold on. Don't get too excited. We need to stick to the basic fundamentals. Regardless of your age, you could be investing for your 15-year-old, or you could be investing in your late 50s, or you could be a young 25-year-old who's raging to get building. You need to stick to the basic fundamentals, okay? So you need to start with low-cost index investing. When I say low-cost index, what's low-cost index? Low-cost index is basically a collection of companies. Let me bring an example. S&P 500, American market, contains ExxonMobil, Apple, Facebook, United Health, United Technologies, combination of different sectors from tech to healthcare to biotech to banks to you need to start investing in low cost. When I say low cost, meaning you can invest, depending on the broker, you can put $50, $100, $1,000. The cost will still be as low as 0.15%. It's less than 0.15%. That's low cost. So it wouldn't eat up your growth of your portfolio. So even all the professionals out there would have highly advised for at least the first 10 to 20,000 US dollar or Great British pounds or euros, between 10 to 20,000, I repeat, make sure you all invest them in low cost index. You can spread them across US market, EU, the UK market, your local market. Make sure it's low cost index. That's first you need to do, because inexperienced, or you might be a slight experienced investor already, but you want to build that solid foundation base, a diversified solid foundation base. Let me give you a couple of reasons why. If there was a market crash or a volatility swing, index is the one that moves the least. If you buy, for example, a high growth Tesla, if it goes down, it goes like a roller coaster. And if it goes up, it shoots up like a rocket as well. Don't let your emotion beat the best of you. You have to stick to the basic fundamentals, and that's where you have to start from. And you will know why when I explain in the next part of benchmarking and how important low cost index is. And once you establish that over a couple of months or a couple of years, gives you opportunity to learn more about the stock market, and then perhaps you can start investing in shares. And if you do start, if you finish 20 grand of index, low cost index investing, and you start looking at shares, where should you go? Where should you buy? So the next step is, I would advise you to go a bit more adventurous, emerging market. High growth emerging market. But at least if you invest in high growth emerging market funds, manager funds, you get a collection of different companies. You might get Alibaba, you might get Tencent, you might Hong Kong Stock Exchange, you might get a bit of Vietnam shares on the textile market. But you do not buy individual funds, shares. You just diversify to emerging market funds. Or if you want to do specific companies, I would recommend to go high dividend, reliable companies. Companies that pays dividends, good quality dividends. If you all follow me on my blog, I recommend stuff like BMW, Shell, BP, Procter & Gamble. You can go to even Apple are dividend growth companies just now. So invest in those and when the dividends you receive, make sure in your broker you automatically invest them into your portfolio. So dividend reinvestment, and then hopefully it gives you the compounding effect year on and so forth. So this is my step. Let me recap again. when you start investing, make sure the first 10 to 20,000 US dollars, Great British Pounds, or the euros goes into low cost index, if you're a broker. And once you surpass that, if you want a bit more adventurous, don't go straight into specific shares. Try go emerging market funds just to diversify a bit, for a bit more growth. Not too much, just a little dice of it. If that's not your cup of tea, then go reinvest in dividend companies. High reliable dividend companies that pay with good cash flow. Don't just look at a dividend. Make sure it's good quality company that you know that's been there 30 years ago and that will be there for the next 100 years. Simple as that. I hope you find it useful. I hope that will help you in your starting investment and get you excited and raging to build a 6-figure portfolio. I've done it in 4 years. I mentioned I've done it in 4 years, and that's what I'm sharing with you all today. So hopefully see you in part 4, 5, and 6. And let's build that dream, my friend. Build that dream.